basically understood the definition of audit here in the last session. It is independent review. It can be an investigation on financial statements. It can be for management accounting, management reports which are there. It is for accounting reports. It is for operational reports, reports of your revenue and expenses. So when we talk about audit, it generally does not get restricted to your only financial or accounting information as such. So the result of reviewing an investigation will be reported. So there is a report which is being made, and the report is being circulated, or whom it is reported to. It is reported to the stakeholders. So shareholders and other key internal stakeholders of the business entity get this particular report. So we understand that it is accumulation and evaluation of evidence about information to determine and report and the degree of correspondence between the information and the established criteria. Auditing should be done by competent and independent person, right? So when we are saying all this, there are a lot of words over here which we are saying accumulation and evaluation. So what is accumulation and evaluation? That is where you collect the data, with whether it is accounting reports or financial statements or management accounting data or report on expenses or report on your revenues. You have to collect that data. So you have to accumulate the data, evaluate the data on basis of evidences and evidences which you get. So evidences, when we are saying what are the evidences over here? As I was telling you, when we do this audit, there has to be some objective evidence for every transaction which is being recorded in the books of account, right? Then it gets reported. It gets reported to the stakeholders. The information is passed on to the stakeholders, and we say auditing has to be done by a competent and independent person. Competent in the sense the person should be qualified to do audit, and he should not independent in a sense. It should be a third party. It should not be a party related to the entity. Objective evidence, when I say, what is objective evidence? Now, whenever you do a record of a transaction, right? Whenever you are doing a record of a transaction in a journal or in a ledger, remember last class we discussed something like vouchers? Yeah? So, when we talk about objective evidence, when a transaction gets recorded, there has to be an evidence that this transaction happened. And this evidence can be a bill, a invoice, a voucher. Right? So that is called as objective evidence. Have I made myself clear? Now, so there are various types of audits which happen in the organization. So first type of audit, when we say it is financial statement audits, evaluates the correspondence between financial statements and GAAP. So GAAP is nothing but your generally accepted accounting principles. Your financial statements. What are your financial statements? The income statement, which we call as profit and loss account also, balance sheet and statement of cash flow are your financial statements, right? So when we are saying financial statements, there are we also understand that when we present this financial statements, or when we make this financial statements, we have to make it in a particular way, a particular format. We record each and every item in the financial statement in a particular way. The amounts are calculated or computed in a particular method has been used, a particular process has been used. All these methods and processes are coming from your generally accepted accounting principles, right? So when you make the financial statement, when you make the financial statements, you have to follow the accounting principles. So financial statement audit sees that the statements are made in accordance to the accounting principles. Is that clear? Yeah. Next is your operational audits. It basically operations talks about your, the effectiveness, the efficiency of the organization. So it evaluates the correspondence. It evaluates the correspondence. When we're using the term correspondence, basically whether it is matching with the organization's procedures, methods, and criteria of efficiency and effectiveness. We also have compliance audits. Now, compliance audits are different from your financial statement audits. Apart from your, what I could say is, apart from your, following the rules and regulations of accounting, apart from following the rules and regulations of accounting, you also have to follow. Yeah, I'll do that. You also have to follow certain, what we call as uh, uh, there are certain compliances which are there. There are certain rules and regulations of operating in the business environment, right? So those compliances need not be straight away related to your financial statements, but you have to follow that. So whether you are following that, for example, if I have to take a compliance audit, uh, they generally say that you cannot, for example, if you are a company which emits a lot of pollutants in the environment, right? So your and whatever is your emission which is happening should be processed and then emitted in the environment so that it does not pollute the environment. So that is a compliance need which you have to follow, right? Is that clear? See, you take a chemical processing industry, okay, chemical processing factory. Okay, when I'm saying it is a chemical processing factory, this particular factory is definitely going to have certain chemicals as its waste, right? So this waste, where will they put this waste? They have to, what we would say, they have to get rid of this waste. So will they dump the waste anywhere? If they dump the waste anywhere, what is going to happen is, uh, what is going to happen? The environment is going to get polluted. So there will be certain what we would say, there would be certain rules and regulations for this chemical industry that they have to process their waste and then dump it so that it does not pollute the environment, right? So that is basically your compliance audit. So audit which sees, now this audit is not actually related to your financial statements. This audit is not related to your financial statements, right? But it is related to the compliances. Whether you have followed the compliances set by the government. So this government body need not be always your income tax authority or a SEBI or a CAG. It can be certain. It can be any. It can be related to any factory. It can be related to any industry. I gave you an example of the factory. I gave you the example of factory, but it doesn't mean that no, it is only related to factory. Banking companies have to follow banking laws. Yeah. So banking companies' compliances would be different than the other companies who are not into banking, right? You know, banking companies as such, the way in which they make their balance sheet and their income statement is actually different, but the way which gets published for a general person is totally different, right? So compliances are something like rules and regulations set up for a particular type of industry or a particular type of business, which need not directly be related to your accounting. Then that is called as compliance. You have to compile with the rules and regulations. That is where we say it is compliance audit. Okay, coming to your operational audits or operational audit, uh, see, business can get a decent idea of how they are doing in operations by examining the company's data on their own. Fine. However, sometimes, it is those close to the company do not actually review this data completely and objectively, because they are so familiar with the operations that it is difficult for them to come up with something which is a flaw in the existing operational system or something, right? So basically, the goal of operational audit is to determine whether the internal controls of the business, such as policies, procedures, everything are in place or not. And there are sufficient policies and procedures. Operational audits would mean it would mean how your factory has a capacity. Again, I'm taking example of factory because it is easy to relate. Say a factory has a capacity to produce 10,000 units in a particular operating cycle, right? So the factory is right now operating. The factory is right now, say, operating at 60% capacity. That means it is producing only 6,000 units. It is producing 6,000 units. Maybe the demand is also only 6,000, so it is fine. But at what level it can achieve the highest efficiency? How it would be more effective? How can they use the capacity more efficiently? All that can come in your operational audit. So it is basically, it is reviewing the plans of the managers, understanding what is the break-even point of the organization. Are they above the break-even? How much they can actually go ahead? All that is your operational audit. Is that clear? Next is your comprehensive audit. Any idea what is